Hey, good morning, options traders. Well, somehow we've gotten on this kick about market liquidity. We started a couple of videos ago from a question from one of our traders asking about the bid ask spread. And I said in that video that volume and volatility were really the two big culprits for creating wide bid ask spreads, but not the only ones. And so we've been exploring some of the other things that can contribute to it. But let's check out another pair, depth and breadth. What does this have to do with the bid-ask spread, and what does it mean when we talk about market depth versus breadth? Well, let's go find out some more. As always, before we do, please be sure to click like and subscribe. It's greatly appreciated and helps to promote the channel. So depth and breadth, these are two terms you hear a lot in the market, and it always refers to the number of shares available at various stock prices on the order book. If we're talking about options, it could be the number of contracts at various strikes, for example. So we've talked about the order book before in previous videos, but let's do a quick review for anybody who might be new. So just remember, whenever you place an order, a limit order, it has to sit on a book somewhere. We don't know if it's going to get executed. Remember, that's part of the definition of a limit order. Guarantees the price, but not the execution. So somewhere on the exchange, typically an electronic book, we have to log all of the bids and offers. So just to make the example easy, let's start with a fresh, clean slate. Let's say it's ABC stock, and we're looking at the number of bids and offers. Right now we have none on the books. So this is what our computer screen looks like. And then we get an order to buy at a limit of 50, 100 shares. Remember what this means, it can only get filled at the limit or at a better price. For a buyer, that would be lower. So buyers place bids, sellers place asking prices or offers. So the computer order book is going to stack this order as buy at a limit of 50 for 100 shares. Whenever you're talking about shares of stock, they are always assumed to be traded in 100 share lots, or what's called a round lot. So if it says 1, it really means 100 shares. If you're talking about the options market, that would be one contract. Now, another order comes in to buy at $49.50 for 200 shares. This, of course, is a buyer, so that's going to get stacked over here on the bid side. But also remember that the markets want to know who is the highest bidder and who is the lowest offer. So the computer's going to stack these by what's called price priority. Whoever is the highest bid goes to the top of the stack. Whoever is the lowest offer goes to the bottom of the stack. So the computer's trying to keep the best bid and best offer, that is highest bid and lowest offer, near the center of the screen. So let's say that a sell order comes in to sell at a limit of $50.10 for 300 shares. This is, of course, a seller, so this is going to get stacked on the asking price. Another order comes in to sell at $50.75 for 200 shares. It's also a seller, gets stacked on the asking price. Again, notice that the lowest asking price, in this case $50.10, is lower than $50.75. So $50.10 gets to go to the bottom of the stack or closer to the center. We get another order to buy at a limit of 49 for 200 shares. This order is not as good as 50 and not as good as 49.50, so it gets stacked on the bottom of the bids. Another order comes in to buy at a limit of 47 for 100 shares. It's a buyer. It gets stacked over on the bid. It's the lowest of the buy, so it goes to the bottom. But now what happens if somebody comes in, let's say, with a buy at a limit of 48.50 for 100 shares? Notice that 48.50 is better than, it's higher than 47, but not as good as 49. So it's going to get wedged right in between those. So again, the computer is stacking these according to price priority. Highest bids go up towards the top of the line. If you happen to get two traders who have the same bid, let's say at 50, then they get stacked according to time priority. They get a little timestamp on those orders, and the earliest trade would have priority over the later ones. So now that you've got the idea, this just continues on and we get, in some cases, very big stacks of bids and offers. Now, when you're looking at your broker's platform, what you're seeing is the highest bid and the lowest offer. It's called the inside quote. So you're going to see 50, that's coming from the top of the stack over here, and you're going to see $50.10 coming from the bottom over here. You will also see a figure called the size that's reported as two numbers. The first number corresponds to the bid, the second number to the ask. So because we're dealing with shares of stock, this means we have 100 shares available at a price of 50 that somebody is bidding for. We have 300 shares available at $50.10. Again, if these were option prices, that would be one contract and three contracts respectively. Okay, so now that you have an idea of the order book, what does it mean when we talk about depth? Well, it simply means that we have a high number of shares at the bid and the offer at a given stock price. For options, it would mean that we have a high number of contracts at certain strikes. So all else being equal, more depth is better. So let's say that our order book looked like this. Well, we don't have a lot of depth. We have a high bid of 50, but it's only for 100 shares. And then we go to $49.99, but it's a fairly tight market, only a penny there, but it's only for 200 shares. Then we drop to $49.98, only for 100 shares, and then we're out of bids. So if you came in here to sell, let's say 500 shares, you've got 100 plus 200 or 300 plus 100 is 400 shares. You couldn't even get the order filled. There just aren't enough bids available. And that also sheds light on a big myth that a lot of traders have. They assume that when you see bid 50, offered at 50.10, it means you can sell all the shares you could ever want to sell at 50 because that's the price, and you can buy all the shares that you want at 50.10 because that's the price. Remember, it's an auction. How many shares are available at 50? How many are available at 50.10? You cannot buy or sell all that you want. That's why depth is important. Okay, now that you understand depth, let's talk about breadth. Breadth means we have a high number of shares across many stock prices. For options, we would have a high number of contracts across many strikes. Just as with depth, all else equal, more breadth is better. So let's go back to our order book and say that we see this layout. And we're going to assume that these prices keep going way out in this direction, and over here on the offer prices keep going way up in this direction. We would have a lot of breadth. We've got, and you can see it's only a penny wide here. We've got lots and lots of breadth. We just don't have any depth. Again, we're fairly granular here at the stock price level, but we just don't have a lot of shares available. Same thing over here, only a penny wide, but there's just not a lot of depth. So if we were to plot our order book numbers like this, we might see something like this. So if we see that we've got, let's say, 1,000 shares at 50, and then it looks like 500 shares at $49.99 and at 50.01, yeah, we do have some depth, but it's just not a lot of depth, and we certainly don't have any breadth. So remember that depth is looking at this direction. How deep is this picture? So if we saw another stock, let's say stock B, that might have the same prices but might have these numbers of shares, then that stock would have more depth. If we had something like this, now we're starting to get breadth. Remember, breadth is the left to right, or how wide is this market? So in this instance, we're going, okay, yeah, we've got some breadth. We have some pretty good depth here in the center. We just don't have a lot of depth. But what if we saw this? See, now you've got breadth and depth. We're going across many, many stock prices, very granular, only a penny wide, but we've got lots and lots of shares or lots of contracts at each of these prices. So this in orange would be a very deep market and a very broad market. So why is this important? Well, again, it's a measure of risk. If we have low depth or breadth, we can end up with what's called execution risk for large orders. Execution risk just means an unwanted surprise from the prices you thought you were going to get. And the reason is that orders may do what's called walking the book. So let's go back to our order book and say it looked like this, and you wanted to place an order to sell 500 shares. Well, you can see it's not real granular. We're jumping from 50 to 49.50, 48.75, not real broad and certainly not real deep. What's going to happen? Well, you've got 200 shares here, total of 300, 400. You could get 100 of these shares. So you would get what's called a multiple fill. You would get 200 shares at 50, 100 at 49.50, 100 at 48.75, and then 100 at 48. And the trader who placed this bid would receive what's called a partial fill and would now have an order to buy 100 at 48. But you're going to look at this thinking, hey, I thought I could sell at 50 because that was the price, and you end up getting as low as 48. Why? Because it wasn't a very broad market or a very deep market. Same thing over here on the asking price. You might see that the asking price is 50.10. So for example, let's say that you wanted to buy 800 shares at 50.10, but you do it at a market order because you're thinking, oh, well, that's the price. I can see it right there, 50.10. But because we don't have, let's say, a market maker or an ECN that's willing to step in and fill in these gaps, you end up with 300 shares at 50.10, 200 at 51, 200 at 51.75, and then 100 at 52. So there's your 800 shares. So you're thinking you were going to get filled at 50.10, and you got as high as 52. Why? It's not very broad and it's not very deep. And that's what causes the execution risk. But what if you saw this? Now we're very granular, only a penny wide. We've got lots of breadth and we've got lots of depth. We've got 2,000 shares, 1,000 shares. It pretty much doesn't matter how many shares you want to buy, unless you're really talking about large orders. They're going to get filled, and they're going to get filled very close to these prices, this inside quote. Why? Because we have a broad market and we have a deep market. So now that you understand depth versus breadth, let's jump over to E-Trade and see how you can find out what these numbers are in your broker's platform. Okay, so now we're into the E-Trade platform, and I'm going to start with Microsoft, which is certainly a very liquid stock. But is it as liquid as you might think? Well, first of all, check over here to the bid and the offer that we talked about. It's 419.07 to 419.13. So that's about 6 cents wide. Not quite as tight as you might think. Over here is the size. Look at this, 1/2. Now 3/2. So there's only a handful of shares at the bid and the offer. Now, realistically, if you were to place a very large order, even 5,000 shares, it's probably going to get filled by a market maker, an ECN. So just because they're not posting the size doesn't mean it's not there. And that's why it becomes very difficult to say what is the true depth or breadth. But remember, this is the inside quote. And if we want to see behind the curtain, so to speak, we need to go to what's called level 2. Now in E-Trade, we do that by going to the quote screen, and then we scroll down here. And these are the various exchanges. Probably easier to flip it over to total, and we're seeing out of all of them, how many are bidding 419.15? Well, there's 500 shares. Then we drop to 419.10. See, there's a 5-cent discrepancy there. And then 418.57. That's a pretty big drop. See, it's not as broad as you might think, and probably not as deep. 100 shares, 300, there was 20 or 2,000 shares for just a split second. We can see over here on the asking price, 100 to 500, 200, 600 shares. They change very quickly as they get picked off. Obviously, this is a very high volume stock. Now, once again, just because you might only be seeing 100 or 200 shares doesn't mean you should really be in a lot of fear for placing an order for 1,000 shares of Microsoft. Granted, it would be a big order, but it would probably get filled all at one price. So again, remember, just because these ECNs or market makers might only be showing a handful of shares doesn't really mean that's all that they're willing to trade at these prices. But those are the actual quotes that we saw in the presentation in real time right there that we can see in what's called level 2. Now let's go to something that's less liquid. Let's go to Eagle Bancorp and take a look over here. Now you can see that these sizes aren't changing because it just doesn't have the volume of Microsoft. So only 100 shares at each of these prices, but we go from 29.66 to 64 to 55. That's a 9-cent drop right there. Then only a 1-cent drop right here. But you can see not a lot of depth, not a lot of breadth. Over here on the offer, 29.71, then we go up to 82. It's 11 cents. Big jump. Then we go to 83, that's only a penny higher. And then to 97, that's 14 cents higher. See, it's not real deep and it's not real broad. And because of that, you can end up with execution risk. So the main point to take from this is when you have stocks that don't have a lot of depth or a lot of breadth, there's nothing you can do about it, but that's one of the factors that will contribute to having wider bid-ask spreads. So just remember, you can't trade the market that you want, but you can trade the market that you have. And to do that, you need to understand what are some strategies for either placing orders, but more importantly, how to hedge, roll, and morph as things change once you're in the position. Managing risk after the fact is far more important than worrying about a wide bid-ask spread. And for anyone who'd like to learn more about the art and science of options trading, please check out the Alpha Trader course, Strategy Lab, and a Candlesticks and Technical Analysis course. It's all at optionsatoz.com. Also, please join us on Options A to Z's Facebook trading group, and you can find a link in the description below.